Hi everyone, I'm Dr. Sarana Kumar, Assistant Professor, Department of Management Studies, SNS Institutions. So last session we discussed about sources of finance and sources of finance in the sense every entrepreneur you need a fund from any sources. That's only we discussed about friends and family, loans, government grants and schemes, incubators, accelerators. So everything we discussed. Now we are going to discuss about the continuation of trade credit. So everyone know about the trade credit because it's a very helpful for an entrepreneur to run a business. So trade credit is a type of short-term financing. It's not a long-term. Short-term financing where suppliers allow businesses to provide goods or services now and pay later, usually within 30 to 90 days. For example, you are not having money, so you need quality raw materials. So if you are going for the trade credit, so trade credit it's a short-term financing. So that's only I said 30 to 90 days you have to pay the amount. So next we are going to discuss very important what is capital structure, because everyone know if you're going to start a business, capital is very important. So capital structure means how a business gets money it needs to start and grow. It's the mix of money from owners, equity and money borrowed from others, debt. So what are the key concepts of capital structure in entrepreneurship? Definition like that define that capital structure is a combination of different sources of long-term finance used by an entrepreneur, typically including equity capital, debt capital, and retained earnings. So we will see one by one. Equity capital, it's nothing but funds raised by issuing shares to investors. Because every business, if you take it as every entrepreneur, they are going to invest in shares. Now you have seen the lot of examples also in Tata or Apollo Hospital or anything, any manufacturing industry, any healthcare sector, any digital marketing. Everybody they are going to invest the shares. So, including personal savings or contribution from family or friends, angel investors, venture capitalists. So they are all equity capital. Debt capital, borrowed money, bank loans, credit lines, and debentures that must be repaid with interest. So debt capital, hybrid instruments is nothing but the combination of both instruments like convertible debentures or preference shares that have characteristics of both equity and debt. So next, importance in entrepreneurship development. Financial planning, we already discussed about the financial planning. So helps in assessing how much capital is needed and from where you need that financial planning. We already discussed. Then risk management, a balanced structure helps manage financial risk and ensure business sustainability. So how to sustain the business is very important. So and also the risk is very important for an entrepreneur. So that's only we are saying in that initial period itself, who is an entrepreneur, a person who is taking risk and achieve the returns. So growth enablement, adequate capital allows for scaling, research and development, hiring and marketing. Investor confidence, a well-structured capital base to attract investors by signaling and stability. What are the factors affecting capital structure decisions? Business stage. Business stage is nothing but startup or growth or maturity. So everyone know about the product life cycle. So there are 5 stages in the product life cycle: introduction, growth, maturity, and decline. The same like that, they are having the 5 factors. They are affecting the capital structure decisions. Number one, business stage. It's a startup or growth or maturity stage. Cost of capital, interest with ownership dilution, cash flow predictability. Predictability, tax considerations, control preference, debt keeps ownership intact and equity dilutes it. So, what are the challenges for entrepreneurs? Limited access to formal credit. So, what are the challenges? As an entrepreneur, they are facing n number of challenges. So, in the challenges, we are saying that very important limited access to formal credit and high cost of capital for early stage ventures, pressure to give up control in exchange for equity, need to balance growth with financial prudence. So it means limited access to formal credit, where you will get the credit, the sources are very less. So with the help of the less sources, you will get the credit. That's very important for, because in that early stage ventures, in the initial stage, you need more money to invest in the business. Then next we are going to discuss what is a term loan. Still now we discussed about that trade credit, government grants and schemes and everything. Next one is term loan. So a term loan is a type of financial assistance provided by banks or financial institution to entrepreneurs or business for a specific amount to be repaid over a fixed term, usually with interest. So before we discussed about the term credit, I mean that with the short term financing, 30 to 90 days you have to pay the amount. Now we are discussing about that term loan. It's repaid over a fixed term, usually with interest. So the loans are used for financing long term assets or development projects. So that's a short term financing, it's a long term financing. So importance in entrepreneurship development, term loans are crucial for entrepreneurs because it will be very, very helpful for the entrepreneurs, especially during the early or growth stages of your business, as they provide necessary capital for fixed assets like land, building, and machinery, enable business expansion or modernization. If you want to expand your business, so you need a term loan, it will be very helpful to run your business, to operate the business, help in launching new products or services. You are going to the diversification. The word diversification is very important in the management. So in your product, for example, if it is a Reliance, so Reliance Petroleum, then Reliance Telecommunication, so they have to develop the diversification of the products, the brand name like Reliance. So launching new products or services. So support infrastructure development also. So these are all very important for an entrepreneur to get the term loan. So, what are the sources of term loan for entrepreneurs? Commercial banks. It's very, very important. So, offer structured loan with competitive interest rates. So, development financial institution like Small Industries Development Bank of India and IDBI, Industrial Development Bank of India, state financial corporations, microfinance institutions, government schemes like Mudra, PMEG, Prime Minister's Employment Generation Program. These are all the plans. It will be there. These are the institutions with the help of the commercial banks to provide fund to the entrepreneurs. So type in the sense short term up to 1 year, working capital, immediate needs, medium term 1 to 5 years, equipment purchase or moderate expansion, long term more than 5 years, land building, large investments. So these are the sources of finance. It will be helpful for the entrepreneur to run the business. So thank you all for watching. Thank you all. We are going to discuss other topic in the next session. Thank you.